Now we had a slew of data out from the mining sector today. We'll dig into that with Peter Major from Cadiz Corporate Solutions. Peter, welcome to Joburg. I'm sure Lindsay's missing you terribly because you're always down in Cape Town.
I think he's glad I'm gone.
But let's get a sense of, you know, with the slew of news coming out today from the mining sector, how would you describe the state of mining in South Africa today?
Look, everybody's got a view. Unfortunately, most of it's negative because the state of mining is under pressure here. Commodity prices are down 30 to 50% from 2 years ago, and costs relentlessly go up double digits every year. And we've got a plethora of legislation, a plethora of uncertainty. We got two major unions duking it out, doing crazy things that they normally wouldn't do or agree with because they think that's the only way they get members from each other. So yeah, maybe saying it's under siege is a little dramatic, but I'd rather we act dramatic now, overreact, and rectify what we can. And the production numbers that have come out so far are not bad. It shows increased tonnage, which is the easiest way to lower costs because it means you have a little bit better productivity. But there's not a lot else you can do. When the commodity price is down like it is now, you've got to focus on productivity. You've got to cut costs wherever. You cut costs across the board. Everybody plays a role in cutting costs.
Peter, it's all about the commodity cycle, of course, and obviously South Africa has its own specific problems when it comes to labour and all sorts of regulations that are put in the resources companies' way by government. Let's be plain about this. But on the other hand, resources companies in this country are really resourceful, pardon the pun, and I thought those Anglo-stable numbers were pretty good, not just in South Africa, but also overseas. So when the good times return, in other words, when the prices start to rocket again, which they eventually will, then they're set to fare, wouldn't you say?
Look, everybody's resourceful when he's under the gun. And what would help a lot is if everybody else plays their role. In other words, managers can only do so much. Employees can do quite a bit. Legislators, government officials, the union officials. If you look at the auto manufacturers in America, when they go through a rough time, the most important person is the head of procurement. And what's he do? He calls in all the suppliers, and usually it's pretty blunt. He tells the guys, you're gonna cut your prices 30% across the board, or you're out of work. You know, they do it very blunt. No, we don't have to be that blunt, but it means everybody has to contribute because boy, everybody got a good bonus, everybody got a big raise, everybody got to double and triple his prices when commodity prices went up for 10 years. So there's a counter to it, there's a corollary.
Peter, there'll be viewers out there with cash burning in their pockets and looking to deploy it. So the $64,000 question, would you be putting fresh money to work if you were brave, in a Kumba or an Anglo generally, for instance?
Look, are you a trader or are you an investor? An investor is someone who probably expects a 15% rate of return or better for the next few years. As an investor, I think it's a little early. A lot of these prices, I think, are barely bouncing off this massive fall. And cycles don't turn that quick. We've only been 2-3 years into a down cycle. We had a 10-year up cycle. Now, I can see the gold shares, they reacted first because they fell the hardest and the most. And they've reacted much more than the gold price. I think it's unjustified, but they had fallen so hard. And you can say, Kumba, maybe it's fallen too hard. And whether you're at Allen Gray or Oasis, whether you do a 3-year IRR, a 5-year, you work out what's an average commodity price and how does this company handle an average commodity price. And I know in the 90s, this country's producers handled average and low commodity prices better than anybody on the planet. Across the board, our gold producers, platinum producers, iron ore. Now, as an analyst and a fund manager, you have to say, is the environment still like that? Can we still handle lower prices more? I don't think we can now. We don't have the flexibility and everybody buying in.
Peter, I've got to interrupt you here because in a few minutes' time I'm going to be speaking to a chap called David O'Leary from Morning Star. It's on the Money Manager feature, as I say, in about 5 minutes. And I'm just looking at his sheet that he sent me here, and he says the worst performing unit trust in 2014 in South Africa was the resources sector. I mean, I think the worst performing funds were down something like 15%. This says to me that this is the time to start nibbling away at these things, just because I need to be contrarian, and because of the industrials and the financials doing so well, now is the time to get in. Whether you like unit trusts or not, I don't know, but surely now is the time to start nibbling.
Look, this is the perfect environment for contrarians. I think mining has averaged minus 3% for the last 5 years. That's unprecedented. I can go back 100 years. I haven't seen mining do minus 3 5 years in a row. If you compare mining to the financial sector, mining to the industrial sector, it's been this low twice in the history of man, and it didn't stay at this level very much. So I agree, Lindsay, just as a contrarian, because it's so relatively oversold compared to everything else, it is worth having some. I definitely wouldn't be naked here. I'd probably have half index weighting, and I'd be looking to buy more on more pullbacks, yeah.
Let's talk about Glencore for a moment. News coming out today that they're considering shutting down their coal mines in South Africa. Should we just write this off to a slump in global growth, or is there more insight that should be had?
There's definitely more insight we should have here, because everybody has the same export steam coal prices. Australia, Canada, America, when you add in the shipping. And we proved what a great mining country we were in the 90s when we were expanding production on most of our mines. Gold was shrinking, but our platinum producers, our iron ore, they were expanding production and coal in really low metal prices, much lower than now. So if Glencore is closing this, are they closing operations in Brazil? Are they closing operations in Colombia? That's what we have to see. If they're closing more operations there than here, then we don't have to be too worried. But if they're closing here and keeping their others open, then it shows we're not a low-cost producer, we're in the middle. And you don't want to be in the middle, you got to be in the bottom quartile.
Peter, just on going back to iron ore, we've seen the price halve since this time last year. Are we in bottom territory now? I mean, oil has come back in sympathy with that too, which has a production cost advantage. But, you know, if you're looking at a DCF, do you plug in 60?
Yes, I usually do. I say, what does the long-term mean? And funny enough, today we had the long-term mean in oil, $48. We had the long-term mean in iron ore, about $59, $60. So you're right. I'll plug in my forecast for Kumba, and if I show a 10-15% pretty solid rate of return at this price, I'll start buying some, because I'll know a lot of the people, probably half the people, can't make money here. So you're protected. But if you have to put in a higher price than the long-term average to get an IRR, I don't think you want to be in that company.
Peter, thank you for making the time to join us and for not getting naked. That's Peter Major from Cadiz Corporate Solutions.